Okay, so welcome everyone to our webinar for today. We have a few people coming into the room today, but I think we probably get started so everyone can continue with the afternoon on time. So today we are very excited about talking a very important topic, which is intragroup services in Asia. And I think one of the things that is important to understand is why and how do we choose our topics and why is it relevant to our audience today. So I think one first thing to note is that intragroup services is probably one of the most common transactions in Asia. I think for those of you who practice either tax or transfer pricing or have been in the Asia region know that there is a lot of share resources situations in the region and a lot of countries that are common to be share services, other countries that are popular to be regional hubs. Hence, the reason why intragroup services is very common. And I think the second reason is the fact that we ran a joke that is that services are a transfer pricing culprit. So they always are blamed for as a means of trying to shift profits from one tax jurisdiction to the other. Um, and unfortunately, when tax authority sees the name services, immediately what it goes in their mind is, oh, profit shifting. But hopefully, in today's sessions, we're able to cover specifically the good practices. So if you have a tax audit or if you have a tax review, then you're able to explain as to why your intragroup service is reasonable and is not an attempt always to shift profits. So before we go into the detail, for those of you who are not familiar with our firm, so we specialize in providing practical, proactive, and cost-effective transfer pricing advice in the Asia Pacific region. We have 4 offices, Australia, Singapore, and Malaysia, and UAE, from which we cater to all the Asia Pacific multinational groups advising in the area of transfer pricing. We also are named Tier 2 firm, and we usually participate in journals contributing to the education of the accounting and tax profession. And we also have a few awards that I think some of you are already familiar with. So our panel for today is a very special one, and I will say why in a minute. So Honchan is special. He's always
I'm
been
not special
special and
anymore.
dear to us. He's our Malaysia director and technical lead, and also has led some of the technical aspects of our firm in Australia. He has been a pioneer in developing transfer pricing practices. He has a lot of experience with planning, documentation, risk management, country by country reporting, tax effective supply chain management in the Asia Pacific region, Australia, the US, and UK. And majority of you already know me. I'm the director of Transfer Pricing Solutions Asia and Malaysia with extensive experience in international tax with big 4 and mid-tier firms, advising multinational companies in the areas of corporate, international tax, and transfer pricing as well. So the reason why today is special is because we have Samuel joining us, who is one of our most, I will say, smart, and not that everyone is not smart, but one of the rising stars in our firm, being one of the very, very hands-on experienced manager with more than 7 years of experience in transfer pricing, conducting projects such as planning, advisory, documentation, country by country reporting in the Asia Pacific region. So basically, today is a very special one, given that we have Samuel as a special guest, given that he has a lot of experience in services transactions, and basically, he will be able to add value to our webinar for today. So watch for him because I'm pretty sure he's going to do great things in tax and TP as well. So we hope we can keep him for the long run. So with that, let us go through the agenda for today, which basically we will be talking about the general approach to pricing intragroup services in Asia. We'll talk about the Asia view through some case studies, and then we will talk about top tips and audit ready. So with that, let me just pass it on to Hongchuan. And Hongchuan, I think one question that I want you to keep in your mind through your session is, okay, is transfer pricing for intragroup services only about doing some documentation and hoping that that documentation is sufficient to explain to the tax authorities? So is that what TP is about, or can you just elaborate what is it about when it comes to services?
Thanks, Ariana. I'm sure this session we will be able to cover more or less on a practical standpoint in relation to intragroup services, right? Because we have been doing intragroup services for quite some time, every year. Intragroup services will always be in our list of transactions as you all know, it's a common transactions that's being looked at, scrutinized by the tax authorities, right? So, but every year we'll try to not just look at the theory part, but more so on a practical sense, what we experienced every year, what's the stand of the tax authorities in relation to intragroup services and how they evolved in trying to scrutinize what type of items they look at, what should we as taxpayers be aware of when we're looking at intragroup services annually, right? Let's first look at the usual stuff. Services, generally speaking, services can be categorized into two, right? We like to do it in a way where we look at value adding services as well as non-value adding, also termed as routine services, right? It's very important in the sense that we will explain later why there's two broad categories, but at the same time, there are actually the services has evolved, right? We have traditional services like administrative, technical, sales, marketing, finance, IT, HR, to rather complex services in the space of IT services, but then this IT can be branched out into various different kind of IT services. Now, previously it was more like IT support, but now it's much more than that. Hence, with the ever-changing economy, when we are now already way inside the digital economy space, services will need to be looked at in detail again. We need to assess because there are a lot of talks about BEPS 2.0 in relation to Pillar 1, Pillar 2, looking at amount B, marketing services. So all this surrounds the recent development that's in the TP space, right? Then next question is, a lot of people ask why companies have intragroup services. I think intragroup services is when we talk about supply chain restructuring, for example, the services that we provide. That's where we start looking at intragroup services, how best to benefit from having intragroup services, how best to gain competitive advantage against other competitors within your industry's position, right? So hence that's where intragroup services comes in. So the next thing that we need to look at, apart from looking at intragroup services, actually looking at not just setting up the service transaction, more so to look at what is the cycle that generally taxpayers will experience when they have a service transaction in place, right? So it starts from first, you have an idea of having a service transaction, or you have a TP planning, or a supply chain restructuring where you have a service transaction in place. Then when you start setting up, right? When you set up, you'll be looking at different analysis to set up, look what services to be provided, the benefit tests, the analysis we will talk about later, setting up. And then after you set up, you implement it, right? You implement the transaction into your ecosystem and actually make it happen, right? Once you have implemented that transaction, you then have your compliance piece into it, right? You have 1 year, you have implementation. The next year, you'll be looking at testing the arm's length nature of that service transaction, right? After having the compliance, which is your contracts, DP documentation, then you go through disputes, potential disputes, whereby you'll be required to have tax reviews on your service transactions, disputes on various matters in relation to service transactions. After which, also you'll be encountering other taxes on not just transfer pricing, right? So when it comes to service transactions, certain transactions will have withholding taxes and other taxes in relation to the specific jurisdictions. So that not just TP.
Thank you, Hunchun. So, can you just tell us a bit like what are the key challenges that we always encounter when it comes to service transactions? So, what's the recurring issues that no matter what type of transaction there is, we always see this being like what multinational companies face?
Yeah, this is the practical part that I've mentioned earlier. So service transaction is 100% the most challenged transaction globally, based on my experience. Right? Every tax authorities will be looking at the service transaction. Now, on top of that, what we have seen previously, which we have already faced, which is quite common, are looking at the service transaction, looking at the cost base, how you set up the transaction, how you implement it. But now there's been a shift for tax authorities to go forward, to go ahead and looking at service transaction as Adrian has mentioned earlier, profit shifting for service transaction, right? Previously, TP, when you look at profit shifting, a lot of the times it's service transaction as well as IP related stuff, royalties, where multinationals shift profits by way of IPs to low tax haven. But now with the IP and the substance and the all the intangible DMPA analysis in place, they fall back to service transaction and say, hey, are there any profit shifting with service transactions, right? Because service transactions is one of the transactions that can be easily or quite often used to shift profits. And thirdly, which is now increasingly more common, where there's inconsistency in different jurisdictions, right? Looking at chargeability of certain activities that is chargeable in certain jurisdictions but may not be chargeable in others, or for example, safe harbor availability in certain jurisdictions while not available in other jurisdictions. For example, Malaysia doesn't have a safe harbor markup, while Singapore has one for their routine services, and there will be inconsistency if the Malaysian taxpayers were to sort of adopt the safe harbor rate as implemented by Singapore, for example. And lastly, there are a lot of operational side of things that are still not regulated, but indirectly required through audit experience. For example, the requirement of having an agreement contract in place is not regulated. You're not required to have a contract, but it's really important to have a contract because of experience that we have doing an audit, right? And looking at operational side, your accounting books, how you record, how you invoice, how it links from your ledgers to your journals. And recently, there's talks about e-invoicing in Malaysia, right? So with e-invoicing, that would obviously assist more, both the taxpayers and the tax authorities. So that would have a provides a clearer picture to the tax authorities. As long, I mean, for the invoicing part, I think that's a good step forward, but obviously another burden for the taxpayers. Thanks, Ariana.
Yeah. So let's talk a little bit about key things on setting up, and then trying to answer that question that I was raising to you earlier. Like, is it only compliance, or is there more to it?
Yeah, yeah. It it's like the whole cycle. When we look at service transaction, this is where it comes in place. When I go back to the cycle, the first thing you'll be looking at is setting up your service transaction, right? When you have an idea of having a service transaction in place with your related party, first thing you need to do is having a price transfer pricing policy in place and set the price. So when setting the price, you'll be looking at performing a benefit test, and then from there, looking at in substance whether service is indeed provided by the service provider in a group. And after which, looking at the cost base. So having the cost base incurred, to sort of look at what are the costs incurred that is directly contributable to the service provided by the service provider to the service recipient. And if there are more than one service recipient or you have indirect charges, then another thing to keep in mind is the allocation keys. So the most appropriate allocation keys, that in itself is also really important, which I guess we will talk about later. And then after which you have your markup by way of having a benchmarking in place, or as I mentioned earlier, some jurisdictions would have safe harbor rates in place to ease the taxpayer's burden without needing to actually perform that benchmarking. So that's on the price setting element. So once you've set the price, once you know what to charge, the next thing would be to actually then formalize it by way of having an agreement or the contracts in place to accurately delineate that service transaction, right? What to ensure that contracts reflect your in actuality, in reality, what you're going to set your price and what you're going to implement. So once you have formalized that, then comes the implementation phase, right? Where you'll be looking at your accounting and finance aspects, your journal entries, now with invoicing. So that will need to be included as part of your accounting and finance aspects to ensure that that it flows from the books to the end to closing to your audit accounts, right? So this is very important.
Thank you, Hunchun. So I think one question that came to my mind is like, why are we so in transfer pricing so obsessed about characterizing these services? And the reason I say this is because from finance point of view, a lot of the finance people or accounting, what they really see is like, okay, there is an interco, I need to raise an invoice, and that's about it. And then when you start asking these questions of, but what is the type of activities, they struggle to understand usually the concept, because we are always very obsessed with it, but they don't really understand as to why it's so important to characterize. So I think it's important to understand that the price a lot of the time is driven. So there is two things. The type of cost that you're going to push down determine or gives you a hint of what type of activities, the type of cost together with the people that perform that activity give you a hint of the type of activity that is being performed in the first place. But
Mm-hmm.
the obsession that we have with it is to make sure that we are not pushing down non-chargeable cost because it's a non-chargeable activity. So I think if you're going to categorize TP nightmares, this is one of them. The one TP
Yeah,
nightmare is
definitely.
pushing down. a cost or an activity that is actually non-chargeable.
Yeah.
And very often we come across to, okay, and just a recent example, we were reviewing a cost base, and then in the cost base there was some accounting consolidated cost, and it was described there. We're like, so what is this related to? Oh, is the group consolidation of the financial statements? Then yesterday we told them, no, that is a non chargeable cost because that's for the benefit of the shareholder. You cannot push down costs that are only for the benefit of the shareholder. So if there is a cost that is for the benefit of the shareholder, there is a very high chance that is then a non chargeable activity and therefore not even discussing what's the price because then it's a cost that should be pushed down.
Yep.
So that's our obsession with type of activities. Then other types, once you agree that is chargeable and that is allowed, then the type of activity does drive a little bit on the price setting as well, which you are going to talk about from a compliance point of view. Then once you set up your transaction, what is key to be able to comply with the arm's length principle from your compliance point of view. So I pass it back to you as well.
Thanks, Adrian. You made a good point in relation to the policy setup, whereby there's always a linkage why it's good to have an agreement in place, right? When Adriana is mentioning about characterization of that service, it doesn't just affect the cost base, having identified the proper cost base. On top of that, every different type of service transaction will have different type of markups in relation to that service. Hence, when you formalize your contract and correctly, accurately delineate it, from there you realize what activities are actually being performed, and then cost base and the markup will follow suit. Now, let's look at testing and compliance. That's after implementing, right? After you have gotten everything correct, hopefully, then contracts done, and when the actual thing has happened, you'll be testing the actual transaction for the previous years, right? So closing of the books, you'll be testing it. You'll be testing the service transaction, and obviously the main thing for transfer pricing compliance would be the transfer pricing documentation, right? So that is a must. That's a requirement depending on jurisdiction and threshold. So we have a TP documentation, and then you have a benchmarking analysis, right? So I'm not saying the benchmarking, in terms of benchmarking analysis, I'm not just talking about, the transaction net margin method, one of the methods which is going through benchmarking searches. But benchmarking analysis involves using the 5 methods to be used, not just a database search, right? So a benchmarking analysis is a must, right? Be it a full TPD or a minimum TPD, you still need a benchmarking analysis to test the arm's length nature of that transaction itself to make sure that you conclude it as arm's length, right? Then the second point is, I think nowadays all the rules is quite in line with preparation of the TP documentation before, at least before the lodgement of the tax return, right? This is important. I think it's already in almost all jurisdictions where this needs to be complied. And before your tax return, you need to have TP documentation in place. Some jurisdictions would have forms that you need to declare, which requires what you have documented in the TP documentation, right? Then to disclose in the tax return. Lastly, obviously, the most important fact would be TP documentation as a penalty protection against the tax authorities, right? It's the Bible for you to defend your transfer pricing position when it comes, right? So TP documentation is prepared, but needs to be kept just for any potential tax disputes, 2, 3, 5 years down the track when that is required, right? So that's really important, right? Oh, TP.
How do you, just if we could summarize in the following two slides, what's generally the approach to test a service and what's the general way in which you do once you have to do. So one thing that is important to uh, uh, clarify or emphasize is that the compliance part is the act of testing a price of a transaction that already happened. Whereas the setting and the implementation part is setting the operational components of the service transaction to make sure that when it is implemented within the organization is fully compliant, whereas compliance is an exercise that we call of testing. So when you're doing the testing exercise, Honchun, what's the general approach if you could just summarize it in the next slide?
Yeah, I mean the general approach obviously is the same for all transactions, but for service transaction, for example, the step one would be your statement of facts, looking at the group operation, what are the services being provided, which is in line with function analysis, whereby that is when you start testing and characterizing what that service transaction should be from the function analysis, like functional risks and assets point of view. And then from step two, looking at industry analysis, looking at the industry where you are in within that industry position. And then the third step would be looking at selecting the methods. As I said earlier, there are 5 methods to be selected. Doesn't need to be the common database search, right? But generally for service transaction, that may be. And then once you've selected the method, then we then actually test it by way of having not benchmarking or other methods, market benchmarking. On top of that, we will also test the cost base as well, not just having a benchmarking done looking at markup. As we have mentioned earlier, we're looking at all elements of the service transaction to make sure that each element are at arm's length, right? So that's important, not just looking at markup itself. Oh, yeah. I mean, yeah, this is the 5 methods that we have, but not all are in relation to service transaction. We have, comparable anchor price method, which is comparison of third-party pricing, resale price generally for distribution, cost plus can be used for service, but there are limitations using of cost plus. Profit split, generally not available to a certain extent, unless you have complex transactions that involves unique contribution to the value creation of the intangible assets. And obviously, the last one is the transactional net margin method, where this is where we're looking at going through a database and search for comparable companies that are performing similar functions, similar services as your tested party, which is the taxpayer. And some jurisdiction would have other methods per se. Like for example, Australia, they have something called a simplified transfer pricing record keeping options, right? If you satisfy certain criteria of that method, then you can forego the 5 methods and then use we call it STPRK to test the transaction itself.
Thank you, Honchuan. So I think we can elaborate on that on the case study, I guess, because it's shocking how little do we have in the region when it comes to indicative markups. And we
Mm,
can talk about that
yes.
during the case study. So, we maybe just for us to close this part, and then before we move on to a couple of other aspects, it's good to put in an example like the different perspectives in terms of how to set up a service. Transaction and how to test it. So let's assume that we have here a regional HQ that provides some services to company C located in Malaysia and company D in Indonesia, and they basically pay let's assume cost plus a markup. So I think if we could just go through some of the key operational aspects that we kind of discussed, but just to put it in the context of this example, um, uh, Juancho, what will be some of the points that you will uh, take into consideration, let's say this regional HQ comes to you today and tell you, hey, we are planning to implement a regional service fee down to the subsidiaries. So what would be the first thing that you will advise them on to do?
Yeah. So I guess the first approach when we generally deal with the regional HQ, the first approach is to come up with the pricing policy of the service transaction, right? From having the pricing policy, we would have conversation as to what service is being provided, right? On a high level basis first, right? Looking at what services are being provided, and then obviously then looking at characterizing the service transaction by way of interviewing the relevant personnel. So from this case study, right, it may only be one arrow, but it may be more. So our approach is to look at what are the service transaction that they want to be put in place, or any existing transaction that may not have been discussed or may not have been put in place, because it's only during the course of our work then we realize that there are actually service transaction that goes back and forth, right? Sometimes regional HQ will be looking at, oh, there may be strategic management services coming down, providing it to company C, but we also will be looking at the other way around. Are there any services being provided by company C back to regional HQ, for example, right? So these are the things that we will be looking at, and obviously from there, we'll be trying to set up what kind of service or transaction, looking at the cost base, benefit testing, substance wise, looking at their organizational structure. They're saying that they have this service in place, but we'll be looking at their org chart and look at what employees are in place in these three entities, for example, right? Are they indeed having employed these people to provide services, and are the recipient benefiting from the services being provided by the service provider, right? So these are things that we will be looking at on first phase, like setting up the transaction itself.
Yeah,
And then,
correct.
yeah.
And then I guess making sure that one formalize the transaction in the contract, um, to make sure that basically we have some uh, evidence to show the tax authorities, especially on the service recipient country,
Mhm.
that there has been some good governance when it comes to setting up the service fee, and it's not an imposition, or it's not an attempt to strip profits out of company C and company D.
Mm.
Samuel, you have been a bit quiet over there. What else would you consider from from an operations point of view here in this case?
Yes, okay. Maybe I'll talk a little bit on the Malaysia and Indonesia side. They are the service recipient and they're paying for the service. So, what is the expectation of the tax authorities in Malaysia and Indonesia when they see company C and D paying a service fee to the regional HQ? So, generally, the first place that they will look at will be your service contract. So, that is the first point. And during any TP review, what they want to make sure is that the actual conduct during that year actually matches what is written in the contract. So what I mean by actual conduct, so from the perspective of company C and D, they will want to look at the substance of the transaction. Is this a chargeable service? Does it provide a benefit to company C and D? And then they would also want to look at, okay, you're charging company C and D for a service fee. So are the right people sitting in regional HQ to perform these services? And when they actually drill down to the cost base, they will look at the cost. Are you including only the relevant cost in the cost base? And and the allocation key as well. So is it an appropriate allocation key? Are you allocating too much to maybe Malaysia or Indonesia? And lastly, they would also look at the markup that you apply. Is it at arm's length? Is your benchmarking appropriate? Is it robust? Does it actually match the service that is being provided by the regional HQs.
You bring a really good point on the fact that basically the substance versus, for example, a regional HQ having a situation where you have no people sitting there and you're charging for some cost versus the situation of being a real regional HQ from operational with people, right? That will make a difference in the outcome in company C and company D. Um, and I think one point to add here as well is also the periodicity in which regional charges for these invoices. And the reason I say for this service, because the reason I say that is because I have experienced that sometimes when the invoices for pushing down costs are very much ad hoc, meaning to say second thinking, all of the sudden at the end of the year, that is a very uh, strong indicator for the tax authorities to believe that is not a service charge being thought well through and is more like an attempt to strip profits out. So I always say if you are going to set up a service fee, just try to do it as if you will hypothesize in a third party situation, which is do your invoices periodically, if possible, every month, if not at least every quarter. So it's not an afterthought and it doesn't look like you're just invoicing one time at the end of the year. Moving on to compliance, Honchon, you remember coming back to your point of the other methodologies in Australia. Can you talk us through to what will be the compliance requirement in Australia?
Yeah, so in Australia, looking at service transaction is more so we'll be first looking at there's a guideline provided by the Australia called the Practical Compliance Guideline (PCG), and the Simplified Transfer Pricing Record Keeping Option Guidelines, actually the 2017-2 PCG, where the Australian Tax Office has been really upfront with what they expect in relation to certain services, in relation to the markup for certain services, right? For value adding routine, which is non-value adding services, when you have certain criteria, when you're satisfied the criteria, some of the criteria involves whether you're already loss making for 3 years. They have included definition of what routine services are in there. They will also provide the safe harbor rate, which is 5% for taxpayers. So once you have satisfied those criteria, you're able to then use the 5% and not perform any benchmarking, right? So the consensus is that you need to make sure that your assessment is correct, right? That's very important, right? If your assessment is wrong, then you may have an issue going forward if the ATO found that your assessment is you're actually not eligible to use that rate, right? Having said that, it's a good expectation for the taxpayers to understand that, hey, the ATO is actually expecting 5%, right? Even to us, even if let's say you do not satisfy certain criteria, but you know that they are actually routine services, you may still opt for having a 5%, right? Because when the tax audit comes in, right, unless you can find admin services for more than 5%, for example, but you have to make sure that it's admin services. The other services is technical services, right? The definition of technical services is design, engineering type services. They provide you a 10% markup. So you need to make sure that the services being provided are technical based, you have technical professional employees providing technical services, right? Then you can actually use that 10% to actually apply it on top of your cost base, right? The only caveat, again, with what we have mentioned earlier, inconsistency in approach, is that when you apply 10% in Australia, it doesn't mean your counterparty will accept that 10%. right? That's the reality, and that's where that there will be discrepancies between, especially technical services. I think for admin type, I think that's fine, 5%. I think that's all right, but 10%, that is only acceptable by the ATO.
Thank you, Hunchun. What about you, Samuel? From Malaysia point of view, what are the compliance aspects to keep in mind?
Yeah. So for Malaysia, apart from your RPT section in your Form C, the main compliance for intragroup services will be your TP documentation. So in Malaysia, you have to prepare TPD every year. So this will come either in a form of a minimum TPD or a full TPD. So this will depend on the size and volume of your transactions.
Thank you, Samuel. And I guess from Singapore point of view, what we have is that the compliance will be documentation if your transaction exceeds 1 million and your revenue exceeds 10 million up until financial year end 24. From financial year end 25th onwards, that we will have that the threshold for service has gone up to 2 million, which is not necessarily very high because in Singapore, we see it on an aggregated basis, not by type of transaction. And being a regional hub, service transactions are very common. In the rest, Singapore has the benefit similar to Australia, but not as good as Australia, that we have incorporated the 5% markup concession only for routine services, and we have a list. Whatever is not routine, then basically has to be benchmarked with a different markup. And I think that's where we are quite different to other countries. I think other countries that have markups for services are mainly India, but they tend to be quite high. Other than that, in the region, we are very uh, poor, or we have very poor guidance and acceptability on markups that are indicatives, which makes it a little bit hard for compliance point of view for services. One other thing to watch out for is the fact that not a lot of tax authorities can take in the leap on defining what chargeable is versus what is not chargeable. But one particular country that is very different to the rest is China, that tends to have a list of non-chargeable activities under a circular that they issue a few years ago. And those non-chargeable services tend to be what we always know in Singapore as a strategic or management fees. There is a list, and they by default understand it as not chargeable. So what that means is that you can push costs to China, but if they fall within the category of non-chargeable, then you will not be able to claim a deduction. So the rest of the countries don't have that definition. You still have to go on the basis of mainly OECD, which is basically, is it chargeable or is it shareholder? Is it duplicative? To assess first if it's chargeable, and then follow the same principles of allocation keys and markups as well. So one other aspect that is very good to talk about, and for that I'm going to pass it on to Samuel. I will say another very recurring question: pass-through cost versus services. Is it same or different? Samuel, with that, I pass it on to you.
Yeah, thank you, Adriana. Yeah, okay. So when we talk about intragroup services, one of the common topics that always come up is pass-through costs. We would always have clients asking for advice. Do I put this in my cost base to apply a markup, or do I just pass it on to my related party? So the main difference between a pass-through cost and a service is that for a service, you have your cost, you apply a markup, and you charge out the service fee. But for a pass-through cost, there is no markup applied. You simply pass on the cost to your related party. So what constitutes a pass-through cost? So it needs to meet these three criteria. So first, the cost is paid on behalf of the related party. So the keyword here to focus is on behalf of the related party, which means that whatever services that you acquire, that you pay for on behalf, it's for the benefit of the related party and not you. And second criteria, the supplier, be it a third party or related party, already charge a market price for that service. So for a third party, generally, whatever they charge is already an arm's length price. But for a related party, you need to make sure that the relevant TP analysis has already been done to make sure it's an arm's length service fee. And the third criteria, the related party that pays is merely a paying agent. So you need to make sure that the role of you in this whole arrangement is limited to only a paying agent, and you're not performing any additional value added functions to enhance the value of the services. So I think this is better illustrated in an example. So here we have a third-party software provider providing services to a group of related party companies. So company A, which is part of the group of related party companies, enters into a contract with the third-party software provider, whereby the services will be provided to the group of related party companies, but the service fee will be charged by the third-party provider to company A, which will then be passed on without any markup to the group of related party companies. So looking back at the three criteria, we can see that they are all met. First, cost paid on behalf of the related party. The benefit is for the group of the related party companies, not company A. And supplier charges an arm's length price. So because it's a third party, whatever they charge is already an arm's length price. And third, we can see that company A in this arrangement, their only role is to pay for the services on behalf of the group of related party companies.
Thank you, Samuel. So this is a very good reminder of where we are in pass-through costs versus where we are in services territory. So
Sorry, just want
yeah,
to add
yeah,
on,
you are,
just
yeah,
to bring
please.
in some food for thought, I guess. I guess in relation to pass-through costs, right? The obviously anything that meets the three criteria, obviously pass it through. What happens if you know we are looking at pass-through costs, but what about the stuff that's being done to pass through that cost? If you get what I'm trying to say,
Yeah,
right? There are certain scenarios where what if I have set up a company and the company's the main business operation is just to buy on behalf and then transfer it to, but at the same time it's not that the company is not doing anything, right? It's doing something, right? So
yeah.
how do we go about this kind of scenario?
That's a good scenario because that will be an exception. Meaning to say that in that scenario, you have to pass with a markup your own cost. So, for example, if company A, which is what you are saying, in company A is set up to find providers for the group of companies and they have, let's say, 5 staff members.
Mm.
So, to do that, let's assume that they have huge contracts with Microsoft and maybe with other providers. So, in that scenario, company A has the right to charge their own cost
Yep.
with a markup,
Yeah.
their own
Yeah, I
cost.
think that would make sense because they're still providing service, but just not that service is provided by the third party, but they have their own service being provided, which is sourcing or dealing with third party service provider.
Yeah.
So yeah.
Do you anything? Do you have any other comments, Samuel, on here?
Yeah, maybe I just add on just to clarify as well. So whatever is being charged by this third-party provider, this this cost component, we do not apply a markup. We simply pass it on. But in the example provided by HC earlier, where company A is the entity within the group that is responsible for this kind of functions, so that will constitute a service. So the cost that we would apply a markup on will be company A, their employee costs, their rental, utilities. That cost will be the cost base where you apply a markup. But just to clarify, the third-party software provider, whatever that cost is, you do not apply any markup because that is a pass-through cost. Yeah.
Yeah, exactly.
Thank you, Samuel. So Just to close off for today, let's talk about a couple of extra uh, points, because usually one thing that we always get asked, oh, is there a way around the markup? Can I ever consider not paying a markup for services? And that's where, when people ask us that question, we're like, well, there is one avenue, but it has some string attached, and
Mhm.
that's cost contribution arrangements. So cost contribution arrangements is, as of today, the only one avenue that ones have to not have to charge markup, but it has some strings attached, because when you see the requirements, you would realize that it's not very easy to fall into. So a CCA, or a cost contribution arrangement, is a contractual arrangement between related parties to share the contribution and risk involved in the joint development, production, or obtaining of intangibles, tangible assets, or services. So it's a joint contribution. That's the key. So if we look at the features of the CCA, we have that there has to have a contractual arrangement, there has to be a concept of mutual benefit, which is key. All participants need to share in the overall contribution of the CCA. All participants need to share the risk associated with achieving the outcome, and all participants exploit the outcome of the CCA. So if we see the example, this is where it has some string attached, is that it requires a co-participation. So we have first a determination of the participants in the CCA, then determine the participants' share of expected benefit from the CCA, then determine the arm's length value of each participant's contribution to the CCA, and determining the allocation of the CCA contribution to each participant according to its share of expected benefit. So if we see here, this was an example of a company that was developing a software as a service, and then they have the R&D teams being placed in two different countries. So they are doing a co-contribution to develop an intangible, whereby company SG located in Singapore has 10 employees and they cost 5,000. So this is an example just for very simple purposes. And then company US has 5 employees and they cost $3,000. So you could pull all this cost and share it by the two entities without any markup, by basically valuing how much benefit are they going to get from the IP development. So in this scenario, you could do a CCA whereby um, you pull the cost without any markup and you share it. Or it could also be that even if it's not an IP, let's say Singapore provides tax services and US provides HR services to each other. You could also have that situation, pull the cost and share it. Now, one question here, which was the case in one core case, is like, is a contribution, can it be in the form only of me paying the cost? And the answer is no. The contribution is not paying for the cost. The contribution is actually doing something as part of the CCA, which is actively conducting an activity. So that's why it's so hard to fall within CCAs, because the whole point of shared services is to centralize services in a particular country a lot of the times and not have repetition of teams worldwide. So the CCA goes very much not in line with that. Hence the reason why it's quite difficult to fall into. But if is the only avenue as of today to not have markups. So the question here is, Honchuan, is are CCAs acceptable in Australia, or are they a thing in Australia?
CCA is available in
Mm.
Australia. I think it's similar. The thing about Australia is that they actually follow closely with the OECD guidelines, and CCA is one of them. And similar to what you have mentioned, I think the really important point is that that there are more than one participant, and both participants contribute and share the revenue, and there is an outcome from the CCA arrangement, right? So those are the keys, and so both all participants benefit from the contribution that they provided, right?
What about in Malaysia, Samuel?
Yep. So for Malaysia, it's also the same. CCA rules are provided in the TP Guidelines 2017 as well as the latest TP rules 2023 under Schedule 3. So it's also largely consistent with the general OECD guidance.
Same in Singapore and the region. Most countries have in the e-tax guide the CCA. Most of them align very much with OECD, which is basically the requirements that we have seen today. Hence the reason why it's a bit hard to fall into. So let's just
We just skip the OECD.
yeah, let's just close today, but just for information for everyone before we close. It's good to know, just for information, that the OECD as of today has basically a chapter on services, has a chapter on CCAs, meaning cost contribution arrangements, and it has a chapter on low value services whereby they recommend that activities that support the group main business that are different from the main and principal activity that generate revenue can use a 5% markup, and the taxpayer still has to document the chargeability of the service and the mechanism, but that is an elective concession that is at the OECD level. But as we said today, this concession is only guidance, is not something that is mandatory to any country. So the country has to implement it in their own domestic law. And so far, Singapore has implemented, Australia has implemented, India has some markups, but they have deviated from the 5% markup. Other than that, there is not much in the region that is where the domestically these low value services have been accepted, but it's good to keep it there in the back of the mind, just in case in the future we have a situation whereby we are able to use 5% markup more widely in the region for low value services. It's important to understand what is not low value services. Not value services is not any activities that generate revenue in the context of the business. So manufacturing, marketing, distribution, R&D, that is no value services. Low value services is mainly what supports the business, activities that support the business, also called in the old times cost centers. So let's go to some of the final key tips before we answer some of the questions that are there. So Honchon, what will be your key tips?
Yeah, I just want to emphasize agreements are actually very important, not regulated, but really important, especially if, more importantly, it needs to be accurately delineated, right? Making sure that the services transactions activities documented are in fact what has been provided by the service provider. And secondly would be I think the setup phase, most importantly, if possible, during the planning phase, have the benefit test done, cost base looked at, chargeable, non-chargeable. Also, the allocation key is very important, right? A lot of people used revenue as allocation key, but revenue is actually not preferred by the tax authorities. You need to make sure that you have chosen the most appropriate allocation key based on the activities in place.
What about you, Samuel? What do you have as tips?
Yep. So markup is a secondary issue, as mentioned by HC. Tax authorities, they focus more on the benefit, cost base, and allocation key. So if you look at it this way, if the service is not chargeable or there is no benefit, the tax authority may just disregard the whole transaction and disallow any deductions. And why is the cost base and allocation key more important than the markup? It's because if you think of it, no matter how much of markup you apply, 10%, 15%, 20% is only limited to whatever cost you have included in the cost base. But nevertheless, well, markup is not as important, but do take note that it's still a core component of any TP analysis for intragroup services. Because if you don't apply an arm's length markup, there will be TP adjustments. Yeah.
Yeah, and then I guess just being
Uh,
aware. Yeah, you go.
yep. Yeah, the fourth point, be aware of service entities. So yes, we need to first establish that the entity is in substance a service provider, because as mentioned, um, first place the tax authorities will look at will be your service contract. But no matter how well worded or robust your contract is, if your actual conduct doesn't match the contract, if your actual conduct it doesn't actually have any substance, no head count, yeah, you there will be no commercial justification for charging that service fee.
Yeah, and I guess for that it's crucial to have a proper functional analysis that
Mm.
corroborates that what says in the contract is what is happening in reality. And just for information, to everyone, some additional documents that we see being asked during audits. One is obviously invoices. The second one is intercompany agreements. The third one is a lot of the times tax authorities making sure that whoever is the service recipient has had some level of arm's length behavior in the context of having some real bargain power, or at least having some negotiation in place rather than being just an imposition from the service provider to the same service recipient. And also some evidence of economic benefits, such as correspondence with deliverables, so what deliverables were given to a service recipient. And in some countries, for example, or some companies may do make sure that they have like a purchase order of the service with a very clear description of what is it that the subsidiary is asking for, why is it that they require the service, and what's the deliverable for the team from the team that is providing that services at a regional level. Um, and I think with that, we can just look if there is any questions from the audience. There is one, but I'm not entirely sure um, uh, uh, what it means. Pass-through costs if criteria different from in-house TP policies. Would we be non-compliant? Not entirely sure what that means. Does anyone get what that means?
It really depends on your in-house TP policy. I'm not sure how what kind of criteria is different. Are you talking about certain elements are within the in-house TP policy? Certain elements is passed through, and certain elements is not. So, I mean, really, you really need to when the TP policy is in place. I would assume that it's being performed by professionals. And on top of that, if let's say there's any discrepancies that you think that it's there's a disalignment between the TP policies and what you think that should be charged, I think this needs to be communicated to ensure that the TP policies is actually in compliance with the TP regulations, so to speak.
Yeah. Any final thoughts, guys, before we go through our last slides? Just to remind everyone that we are in YouTube. We don't charge for webinars, but we like likes. So if you can go and like and subscribe to our YouTube channel, that will be awesome. We have some exciting webinars coming. We have one on 8th of August about IRA's voluntary disclosure. We have one coming on the 16th of August about the changes to Singapore tax guide, and there is another one on 26th of August on mastering transfer pricing with ISCA. Our details are here in the last slide if anyone wants to reach out to us. But any final thoughts, or anything that is still in the queue, or can we close for today?
Yeah, do you have any questions already? Yeah,
Yeah,
yeah. I just want to let everyone know that intergroup services do not understate it. It's quite important. It
yeah.
will make a huge impact when there's a tax adjustment.
Yeah, I think my last remark is that they might keep coming even more, because now with raising cost, there will be a tendency to try to not have too much duplication in within an organization, which means there is going to be a lot more share teams And with shared teams, then there will be a lot more of intragroup services considering the rising cost in general worldwide. So I
Yeah,
think
yeah, definitely.
services are here to stay. All right. Thank you, Samuel. Thank you, Honchuan. It was
Thanks, Adriana.
very
Thanks,
nice
both.
Thank
Thanks,
having you
everyone.
you.
both on board, and we will come back in August. Thank you.
All right, thanks. Bye.
Bye bye.